Well
My
said.
suspicion, where do I think silver might be in six months? Well over 100, maybe 200. Silver had already been going up for years, and suddenly it went berserk. It doubled in half in 6 months.
Yeah.
If we do something similar, the thing that told you back then that it was going to go berserk was the spread. Silver was already full thumbs up, momentum wise, but what told you that I'm going to lift the lid off in relation to gold? And it was the spread. It had similar structural ceiling on it. It broke through, and at that point, the spread said, I'm going to explode. We're facing that door right now. So that's the technical we're watching, not the price or the momentum of price.
Michael Oliver, a seasoned analyst, believes that the silver market is set to explode. Anyone selling silver for under $200 today, according to Oliver, is stepping into one of the largest financial traps in history. He contends that what appears to be a typical slump is actually the last setup before a huge breakthrough that could surprise even seasoned investors. Silver is still locked between $47 and $48, while gold is trading close to $4,000. Oliver describes this as one of the biggest and most unsustainable disparities in the history of the contemporary market. He thinks silver might rise sharply in a matter of weeks rather than years, once the silver to gold ratio recovers. A fundamental reset in precious metals is already evident, as evidenced by the record demand for actual silver, the tightening of supply, and the relentless ascent in gold. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets.
Silver is totally green light in that regard. And we said that back in June, when silver for a third time was coming up into the mid-30s. It had been to 35 in October last year and March of this year, dropped down to 27.5, came roaring up again. And we said when it got above 34, watch out, we're going to break out, but it's going to accelerate the angle of ascent. July, August, September, 4 months, we've gone from 35 to 53, and right now we're 47. What a percent move. It's such a momentum knew that. So from a price momentum perspective, there's nothing more to say. It's already positive. The key is silver spread relationship to gold, which has been over the decades, it's very low in relation to multi-decade levels. But it has a structure where you can look at that spread chart, which is divide an ounce of silver to an ounce of gold, express it as a percent. Right now, silver's like 1.2% the price of gold, which is very cheap. If it breaks through that structure that we've defined, and in our reports we give you the exact number, and you close a month above that spread level, it's saying, I'm breaking out of my spread. When you go back and look at that explosion we had in late 79 to 80, where silver had already been going up for years, and suddenly it went berserk. It like quadrupled in 6 months. Or in late 2010, about 6 months before it hit its peak at 50, in April 2011, silver had already been going up for years, and suddenly it went berserk. It doubled in half in 6 months. If we do something similar, the thing that told you back then that it was going to go berserk was the spread. Silver was already full thumbs up, momentum-wise, but what told you that I'm going to lift the lid off in relation to gold? And it was the spread. It had similar structural ceiling on it. It broke through, and at that point, the spread said, I'm going to explode. We're facing that door right now. So that's the technical we're watching, not the price or the momentum of price.
Well
My
said.
suspicion, where do I think silver might be in six months? Well over 100, maybe 200. Let's go back to gold to get a spread relationship. If you plot gold in relation to the S&P, since the year 2000, it's been very zigzaggy, but it's been net up dramatically. Okay, gold is beat over that 20-year period, October 2020, October 2000 to this October, 20 years. Gold's gone up like 16-fold. S&P's gone up 4.5-fold, which is the better place. Yes, there have been some big bear markets in gold, also the stock market. Net on balance, gold's beat. Now, however, since its 2011 peak in gold, its spread versus the S&P also dropped, meaning gold underperformed the S&P during its bear market, 2011, 12, 13, 14, 15. Starting in about 2015, if you plot the spread, divide gold, ounce of gold into S&P price, and plot it month to month, percent, you've been in a basing range where at the top of that range, the gold performance will surge up to a given level and stop, come back up to a similar level, stop, and has built a beautiful trend line going back 11 years with 4 pivot points hitting it. Intra-month this month, we've been out above that breakout point. We backed off hard last week, when we had the drop in gold and silver, and I don't know how we're going to end the month. But if the gold is 60% of the price of the S&P, it's a major breakout. It's telling you I'm gone. Okay, it's going to break out. Now, when that spread breaks out, the net price of gold it's just the beginning. That spread is telling you at that point in time when you break that spread out, and if it doesn't happen this month, it's going to happen soon. I can tell.
Yeah.
It's telling you it's a new game.
Yeah.
It's not an old trend. It's new. No, they don't. They create inflation ongoing. If you define inflation properly, which is the degradation of the increase in supply of money units, pieces of fiat paper that are worth nothing but the paper, if even that, whether you're talking yen, euros, or dollars, or other similar currencies that aren't backed by anything but government chest beating. Okay, they're not worth anything. At least the tulip bulb mania, the tulip had some value. Okay,
Yeah.
It was pretty in your garden. Okay, but this is a piece of paper that decade by decade increases in quantity about 90%. Dollar M2. Look at the M2 money supply and go back to the 60s and then look on the Federal Reserve chart and see where it was in 70. Do the math. 70 to 80. Do the math. 80 to 90, etc. It's almost 90% every year. Increase in quantity, meaning its buying power continues down. When your granddad built a house, it cost $4,500. Your father had one, it was $45,000. Now it's $450,000 is the median home price. That reflects the degradation of the money in it, not the increase in the real value of a home. So gold is constantly expresses, shows, reveals in its inverse way the ongoing degradation. So when the central bank says we're going to control inflation, well, if they did, they'd go to a backed currency unit and not print at the moment's demand. When something weakens that they don't want to weaken, they want certain prices to come down, but they don't care about the stock market going up, inflated. They don't care about T-bonds being inflated. And so if something happens in those markets that they favor, then they'll print. And they always print. The only question is, to what extent? Is their pedal fully on the floor, or are they only pushing halfway on the pedal? You break that stock market, they'll push fully on the pedal. The problem is, when they do that, 2000, 2002, 2007 to 2009, they pushed the pedal. It didn't save the stock market. It went into gold.
Oliver notes that gold is starting a new breakout against stocks, indicating that money is shifting from paper assets to real ones. Since 2000, gold has outperformed the S&P 500 by almost 4-1. The data makes this change clear. Since the beginning of the 60s, the US money supply has grown by about 90% every 10 years, steadily devaluing the value of the dollar. Oliver's analysis is being validated by recent market movements. Silver has increased to about $48, bringing the two metals closer together, while gold has soared past $3,800 to $3,900. This type of narrowing spread was precisely what his momentum models predicted. Additionally, he is keeping an eye on the Bloomberg Commodity Index, which has been steadily establishing a foundation for almost 2 years. He claims that if it materializes, it will validate a significant capital flight from inflated stocks and bonds to tangible assets like precious metals, grains, oil, and copper. Show some love by hitting the like button, subscribing to the channel, and turning on notifications. Your support means a lot.
I think we're about to accelerate it again in a way that average guy notices. Now, admittedly, commodity prices, raw commodity prices, as in the Bloomberg Commodity Index, is not the full explanation of what CPI or wholesale prices are, okay? They have other metrics that they look at as well. But that's a heavy influencer. So if the price of beef, the price of gasoline, the price of copper, all these things go up, it's going to impact those even more, reflecting movement of money that they've created out of the paper asset category, the stock market, which decides I've overdone it, I'm going to go down, okay? That money flows, and when we do our analysis of the current Bloomberg Commodity Index, it's dancing this month on either side, and right now it's like 1/2 of a point below a massive monthly closing breakout level that says, I'm waking up again, meaning money is flowing out of what? Paper assets into real-world assets, because they're cheap. They've proven they're not going down anymore. They've been sideways for 2 years. And suddenly that's going to smack you in the face, because not just gold and silver going up, but suddenly, oh my gosh, grain prices. Oh my gosh, gasoline's going back up because crude oil is. All these things will hit you. And that the Fed will have to, their two mandates. One is to try to keep that down. They can't opt that way, because what's going to be happening on the other side of the equation, money flow out of the stock market and debt markets. They're going to have to answer that issue. They will shift to monetary excess again. When the Bloomberg breaks out, which is a nicely balanced basket of commodities, it's not heavily in just energy, for example. When it breaks out and we're dancing with the numbers, and we will tell in our reports, at that point, I would take a look. If you only want to invest in stocks, not commodity futures like copper or something like that, or oil futures, but stocks, I would look at stocks related to those commodities, like base metal mining companies, oil production companies, oil exploration companies. So look at the commodity side of the equation, because these stocks don't behave like the S&P. You overlay some of these stocks going back 10 years, they don't even look like the S&P. They look like commodity that they reflect, whether it's copper, sugar, crude oil, beef prices, etc. That category is likely to go up very well during a commodity downturn. It's done it a couple times in history. 2006-07, it went up nicely on the coattails of gold, but in fact, in 2008, for example, give you an idea about price levels. Bloomberg Commodity Index was 238. Okay. Now, over the last year, we've heard, commodity prices are high. It's 107, 238. Commodities are very depressed, even in relation to their own prices, much less in relation to the stock market. That's a place to be. It's likely not to beat gold and silver, but it is a stable, real-world investment asset place to be. So people who claim Bitcoin's done better are wrong. It's flat. And we're arguing it's about to break down. Now, the problem with Bitcoin breaking down is this. It's no longer just some off-to-the-side market. It's too many companies are up to here involved in crypto in one way or another, such that when that asset does break, and we think it'll break sharply and crash-like, when that happens, it will ambush companies that have nothing to do with crypto and yet do. Hence, it will hurt the stock market. It will be like a torpedo they're not looking at. They're all looking at what's NVIDIA doing. If it's okay, everything's fine, right? Well, watch the financials and watch Bitcoin.
Mike, I did a chart for my subscribers the other day. And do you know which commodity is the best performer since January 2020? And it's not gold, it's not silver.
Best commodity since 2020?
Since January 1st, 2020, it's uranium.
Oh, yeah, uranium. Our view on uranium, in 2018, we turned bullish. Uranium then was coming up above $20. Okay. Nothing between then and the high a year ago, like a quintupling in price, altered the annual momentum positive trend. We did enough damage last summer coming off that high. In the mid-80s, like at 85 level, we put out a report, Bitcoin's going to have a major correction. We argued that probably the correction would carry you down to the 70 level, give or take. We got into the 60s, got back above 70, into the 60s, but we've been basing either side of that level, and I think right now we're about 77. I think uranium is about ready to turn back up again after that serious correction.
Michael Oliver concludes his talk by moving the conversation away from precious metals and toward more general prospects in commodities and tangible assets. He clarifies that investors should take into account businesses associated with commodities like base metal miners, oil producers, and exploration firms if they would rather own stocks than direct exposure to futures like copper or oil. He claims that the movement of these stocks differs from that of the S&P 500. Rather, their performance closely mirrors the price of the underlying commodities, such as beef, sugar, oil, or copper. These industries have historically performed well during commodity upturns, particularly when traditional stocks perform poorly. Oliver concludes by discussing uranium, which has more than fivefold increase in value from roughly $20 to the 80s, making it the best performing commodity since 2020. He is cautious about pursuing uranium at this time, despite acknowledging its strong performance and the global shift back toward nuclear energy. He asserts that the big move has already occurred and that uranium might not perform better than other energy sectors sectors, such as oil, which are still over 50% below their peak prices and at historically low levels when monetary expansion is taken into account. Oliver essentially discusses rotation and realism in the outro. He thinks that investors should concentrate on physical assets like commodities, resource companies, and precious metals rather than paper markets and inflated tech stocks. These are the industries that are most suited for the upcoming significant leg in the global financial transition, have real-world value, and are presently undervalued. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.